So what do changes in interest rates mean for the average people like us? So interest rates are determined by the Fed, and if you ever hear about the Fed wanting to cut rates or raise interest rates or things like that, a lot of people don't really understand what that means for people like us, so I wanted to talk about it. So let's discuss. Changes in interest rates directly affect how much money you pay to borrow money and how much you earn from savings, impacting everyday expenses like mortgages, car loans, credit cards, and, like I said, the interest that you receive from your bank accounts. So, in a nutshell, when rates go up, borrowing costs increase, making purchases and debt more expensive. When rates drop, borrowing becomes cheaper, but savings accounts like high yield savings accounts and normal savings accounts typically earn less interest. That's to summarize. So what does this mean for the average person? So the first thing is borrowing costs. So higher rates mean that you pay more interest on debts, and lower rates make it cheaper to finance a home, car, or pay off credit card balances faster. Monthly payments like mortgages and car loans, those rates can shift along with the Fed interest rates. So monthly payments can rise or fall, again following interest rates. Credit cards with variable interest rates can adjust quickly with the Fed, which translates to higher rates raising your minimum payments and lower rates decreasing them. If you look on your credit card statements, depending on the type of credit card that you have, unless for some reason it's like a fixed interest rate or something like that, if it has a variable interest rate, it usually has a range, 20 to 30% for example. That all depends on the interest rates and how much it costs to borrow money. So in terms of savings and CD earnings, CD meaning certificates of deposits. So when rates are high, you earn more on bank deposits and certificates of deposits. But when rates fall, the interest that you earn drops, meaning that you make less money or you're guaranteed less return. Sometimes this can barely keep up with inflation. In terms of spending habits, cheaper borrowing, low rates, in parentheses, encourages spending and big purchases. This is supposed to fuel the economy and increase the amount of money in circulation. High rates, which means it's more expensive to borrow, makes people pull back, which slows down the economy. That's a main reason why central banks change rates to either speed up or cool down consumer demand. I believe that's why the Fed wants to manage rates right now, because inflation and everything is just out of control, tariffs and everything. People aren't really wanting to spend money right now, so they should be lowering interest rates to encourage more consumer spending, but we'll see. In terms of investments, rising rates can make stocks less attractive compared to safer investments like bank yields and bonds. Bond prices can fall as rates go up, since older bonds will pay less than newer ones. However, lower rates will have the opposite effect. If you're looking to buy a home, lower rates can make homes more affordable because mortgage rates are lower, so overall it makes your cost to borrow lower, which makes it more attractive to want to purchase a home through the banks. Rates can quickly increase though, which can push your monthly payments out of reach, especially with rising housing prices. Usually if you hear people about refinancing their mortgage or something like that, that's usually when rates fall so that people can capture a lower interest rate and make their overall mortgage and cost to borrow a little bit cheaper than when they initially bought their home. So ultimately, these interest rates can rise and fall, and these ripple through almost every financial decision that you can make when it comes to borrowing, saving, spending, investing. It impacts a lot of things. For someone trying to build wealth or manage their money, understanding rate changes and how it affects all the things that I mentioned, like investments, savings, cost to borrow, stuff like that, can help you strategize for debt payoff, refinancing, when to buy, big purchases, and even how to maximize savings. Even if you're just trying to survive inflation or snag a car deal, interest rates play a really big role in that. And it's really important to at least pay attention to when you hear about the headlines of whether or not the Fed decides to cut rates, raise rates, or whatnot. Again, it impacts a lot of our financial decisions day to day, and especially the larger purchases. So this is just something I want to talk about. What the fuck do interest rates even mean for people like us? And I just wanted to make a quick video, nothing too fancy, and I hope it helped. Peace.